Well, it's been a while since I provided everyone with an update of my portfolio within the Trading 212 account, so we're going to be focused on that at the end of this video. But before we do, let's take a look at the current rate of inflation within the UK. So before we jump into what the current rate of inflation is within the United Kingdom, we first have to understand what inflation means, and more importantly, how does inflation impact our daily ability to spend? So the definition of inflation is varied, but in short, it is the general increase in prices and the reduction in the purchasing value of our money. So let's take the basic example of buying toothpaste. So year on year, you may notice that there is a general increase in the price of basic items such as toothpaste. And what happens is the income that you had from the previous year, should you spend it the following year when inflation increases, you're effectively spending more money for the same item. And so inflation is really important to think about because you are effectively getting less than you would have the previous year. So to accommodate for the increase in inflation each year, we need to consider where we should place our money year on year and where can our money best grow. So traditionally speaking, the way in which many people within the UK and across the world is through accounts in building societies. So on the screen I have Nationwide, which is just one of many building societies in the UK. And from there is a range of products that you can use to save your money with the goal of receiving interest. So on the list we have a range of current interest rates that Nationwide is supporting. So earlier on in the year, there was an account that gave 5% for the first 12 months, up to £2,500. So what that meant was, in the space of 1 year, you would receive £125 of interest, which is a really good number, but keep in mind that you are limited to the amount you can put in. So in the example I gave, it was £2,500. Any money above that wasn't earning much interest whatsoever. At the time, I think it was an extra 1% for the remainder. So looking at the current list of Nationwide accounts, the interest rates are all lower than the current rate of inflation, which is very disappointing. Other than the Help to Buy ISA, now that's quite limited for those who are planning on buying a home. Again, 2.5%, extremely low, and sort of the 3% if you are saving for your children, still low compared to in the past. So keeping that number of the inflation of last month around the 1.7, 1.8%, should you put your money in any of these accounts below, so 1.5% and below, your money is depreciating in value. So it's becoming lower and lower as the year goes on. So putting your money in, for this instance, in the Nationwide account really isn't a great option. The best thing we can do is look at alternatives, other types of building societies. So the next one I have is Synergy Bank. Now they have a 1.45% for the first 12 months. After that, it drops down to the point where you just open up a new account and renew. But again, 1.45%, that is much lower than the current rate of inflation for the last year. So if we go back to the graph here, it's sort of at the 1.7, 1.8% mark. We can zoom in to see how this year has been. And although inflation has been dropping, we are 1.7%. So even opening an account with Synergy Bank is still depreciating in value. So let's look at one more example, and it's the Al Rayyan Bank. Now this is a Sharia compliant savings, and so what it means is rather than giving a fixed interest rate, instead you are provided with an expected profit. So based on previous years, the rate is generally aligned, and so for argument's sake, you could see it as the amount that is described in, as you can see here, the expected profit rate, the EPR, that is generally a solid number that you can look at the historical data and see that such percentages are accurate. But again, it's not completely confirmed, it's just an expectation. So looking at the types of accounts, there's a whole range here, but the one that sort of caught my eye here was the 12-month at 1.85%. So this account does actually beat inflation, but a very small margin. And given, again, on the graph here, back in 2018, we went over some of these values as high as almost 2.7%. So that's something to keep in mind as well. Although the rate of inflation is dropping, we could still increase in the future. So we've gone through a few of the building societies that pay some of the highest savings account rates, and even then they do not beat the rate of inflation. So the question is, should we still be opening some of these accounts and having our money set aside? And I would answer with yes. And the main reason is we want to make sure we do have a set of money put aside for an emergency fund, whatever that may be. Once you're comfortable with the different types of building societies, generally speaking, most people will have just one account and they're very loyal to the building society. I take the different approach. I open up many accounts within the UK, and from there I can distribute a small amount to earn a certain interest each year. So once you've opened up a few accounts, you've distributed some of your income into those accounts, you now have an emergency fund in place. And from there you can focus on your dividend-based portfolio or an ISA account, whatever it may be, that is somewhat more riskier, some would argue. But at the same time, you're gonna be gaining way more interest. So that's a quick look at the traditional way that people would try to save. And we can see how it's very hard. In fact, even if you are making money through the savings account, you're still not beating inflation. So year on year, the amount of wealth you have is depreciating. So let's look at the Trading 212 platform and see how it's been performing recently. So for those who are new, I have a dividend-based portfolio in which I deposit around £100 every month, just to show the process of making a profit and with the end goal of having passive income. Okay, so let's have a look at the portfolio. So we can see some of the new stocks that we didn't have in the previous video. The first one, GE, or General Electric. So this was a free stock, and for those who want to use my sign up link, the link is down in the description. So what will happen is if you open up a Trading 212 account, deposit £30 or more, you will receive a free stock up to £100, so from sort of the £10 mark to £100. And equally, I receive one. So on my end, I only received that a maximum of 20 times. It's happened 2 or 3 times now. And so you're free to use that link if you want to sign up. Again, I don't really care if you do. I will probably remove some of these free shares, but it's free money anyway. So the next position that I bought recently was HSBC. So I bought quite a lot just because the price was at a nice level. So £5.88. It's since increased, but I guess for anyone else who plans on copying me, I don't recommend you ever do that. You should make your own investment decisions. But be aware that some of the techniques that I've shown in previous videos, HSBC is on more of the high risk level. So that's something to keep in mind. At the same time, some of these companies that are struggling, the ideal situation is that we can hold on to this stock for as long as possible and the company just improves in the long term. So sometimes there is a slight gamble in terms of whether a stock will continue to do well in the future. That's something we have to monitor over time. Okay, so the next stock that I brought into recently was the AT&T. Now the quantity is a little bit low. I ideally wanted to buy more when the price sort of hit the $36.7 mark, and it has since increased. So I actually want to zoom in a little bit more into AT&T and just examine why I bought at the price I did. So let's just make everything look a little bit more prettier. And we can see I've added another alert, again at the $36.7 mark. So let's just take a look at what happened. So early September, price increase. We had what's called the consolidation period, and that's just where it bounces up and down. Doesn't really increase anywhere, doesn't really decrease. It stays within, well, the $36 mark, and then is bounded sort of top level around the $38 mark, a bit higher. And so when I executed the order price, it was at this 36.7 as it decreased substantially. It hit what's called the resistive level, so this red point here, and then again this green point here, they're all resistive levels. It hit down onto that, and then bounced back up, and then, so the highest point in a few months ago, it's now surpassed that high point. So we're at all-time highs, and expect some resistance yet again. Maybe it will hit back down, maybe it will go even further. But in the long run, I do like the AT&T stock, and it pays very good dividends as well. So I do plan on trying to hold more stock for AT&T in the future. So looking at the remainder, we have Bed Bath & Beyond. That was a free stock. Also Walgreen Boots. There hasn't been any addition to the portfolio there, so just 2 stocks with Walgreen Boots. I do plan to buy more in the future, but the price just isn't right at the moment. In terms of Lloyds as well, definitely plan on buying a lot more shares. The price again is just too high for my liking, and we'll see if the price does drop. And then HP, again, a free stock. Anything with a quantity of 1, it's just a free stock. So unfortunately on the desktop, it's quite hard to see what the percentage growth is on the overall account. But for those who have downloaded the app on their phone, you'll be able to see sort of the total percentage increase. So let's go back to the current rate of inflation, which is at the 1.7% mark. And so I can tell you now from my account that although we have a low amount of money, you can see the account value here, 583, I've actually made over 6% in terms of the percentage increase. So, that's beating inflation, that's beating any type of building society. There's simply no argument that if you look at solid companies, and I wouldn't even say some of the holdings that I have are solid companies, but if you invest in companies that do have potential for growth, then you are going to be beating inflation pretty easily, to be honest. It's very possible that you can lose money, but if you look for sensible companies, if you use some of the techniques that I've shown, then there is an ability to grow your portfolio, to grow the amount of money that you initially had. And in my case, at the moment, it's above the 6% mark. So 6% of just under £600, you can work out what that is. It's slightly under £30, but our plan is just to scale this process up and up. So we'll have more companies that pay dividends. And then the dividends themselves, this account hasn't been open for that long. It's just been over a month. And generally dividend payouts happen every 3 months. So on top of that, we have all that additional passive income that will be reintroduced back into our portfolio. And from then we can just buy more and more stocks. So this entire series at the moment is just to illustrate the techniques to grow our portfolio. Eventually we'll be ramping up production and we'll be, I guess, taking it to the next sort of level. So hopefully this video has been helpful and it's highlighted how you can still put your money in traditional banking societies and to be aware that it's generally difficult to beat the rate of inflation, but it's proven from having a trading platform that it's very easy to bypass the rate of inflation and to just increase more and more going forwards. So thanks for listening, and I will see you in the next one.